Welcome to TalkTickers, the show that takes a deep dive into the most critical insights from earnings calls.
Glad to be here.
Today, we're unpacking the latest earnings call for Jack in the Box.
Yep, JIB.
And, well, it seems like it was a quarter marked by some significant challenges.
That's definitely one way to put it.
But also some interesting strategic moves we should talk about.
For sure. Looking at the headline numbers first.
Yeah, let's start there, the snapshot.
Okay. So Jack in the Box saw same-store sales for their main Jack brand decrease by 4.4%.
Okay, nearly 4.5% down.
And Del Taco also experienced a decline. Their system same-store sales were down by 3.6%.
So both brands feeling the pressure on sales.
Right. And we also saw a bit of a squeeze on profitability. Restaurant-level margins decreased for both brands.
Okay, so tougher on the sales front.
Yeah.
And wasn't there also a pretty significant write-down related to Del Taco?
Yes, exactly. The company recorded a substantial non-cash goodwill and intangible asset impairment.
How much was that?
$203.2 million for Del Taco. Pretty large.
Wow. And why was that?
Well, they said it was primarily due to lower current performance and, adjustments to their longer-term outlook for the brand.
Right. That makes sense. So how did that impact the bottom line overall?
Well, as a result, their consolidated GAAP diluted loss per share was $7.47.
A loss of $7.47 per share.
Yep, which is quite a stark contrast to the $1.26 earnings per share they reported in the same quarter last year.
That is a considerable shift. How did their sort of core operations fare, excluding that big charge?
Good question. Their operating earnings per share, which kind of gives you a view into ongoing performance, were $1.20.
Okay, $1.20.
But that was down from $1.46 year over year. So still a decline, but not nearly as dramatic as the GAAP number.
Got it. And what about investments? Were they still spending?
They were. They invested $21.5 million in capital expenditures.
And what was that focused on?
Mostly areas like technology upgrades, digital initiatives, and building some new company-operated restaurants.
Okay. We also saw some maybe notable changes in how they're managing their capital.
Indeed. Big changes there. The company decided to discontinue both share repurchases and their dividend payments.
Suspending both. Okay.
Yeah. And their debt-to-adjusted EBITDA leverage ratio now stands at 5.5 times.
5.5x leverage. That's getting up there.
It is. Interestingly, though, despite all these financial results, their full-year guidance remains consistent with what they announced previously in their pre-announcement.
Okay, so holding the line on guidance for now.
Seems so.
So with those challenging headline numbers, let's maybe delve a bit deeper now into what's driving these results, starting with the overall sales environment. Sounds like they're facing some headwinds.
Definitely facing headwinds. What's particularly noteworthy is they explicitly mentioned income cohort pressure leading to negative customer traffic.
So seeing pressure on lower income consumers impacting visits.
Exactly. And to address this, they're using what they call a barbell strategy.
Barbell strategy, explain that.
Well, it involves strategically focusing on both ends of the spectrum, attracting budget-conscious consumers with value items.
Right, the value end.
And also appealing to customers willing to spend a bit more on premium offerings.
The premium end, okay, hitting both sides.
Precisely. Alongside this, they're heavily emphasizing digital growth and introducing innovative limited time offers, LTOs,
Those special menu items.
Yep. Keep things fresh. But ultimately, their main focus, their top priority remains boosting those same store sales figures.
Makes sense. And the digital side you mentioned, that seems to be a real priority. They said digital sales are now 18% system-wide.
That's right, 18%. It's a significant chunk of their business now.
Yeah, that's quite high.
And they really underscored that continued investment in their digital infrastructure is, well, essential for their future success.
What does that investment look like?
A key component is the ongoing rollout of their new point of sale, or POS, system.
The system for taking orders and payments.
Exactly. They've now put this new system in nearly 1,500 locations.
That's a lot of restaurants.
It is. However, this tech transition hasn't been entirely seamless.
Right. They did mention some temporary challenges, didn't they? Integrating the new tech with the older systems.
Precisely. These integration issues have unfortunately had a temporary negative impact on their sales.
Okay. How much impact?
They didn't quantify it exactly there, but they did anticipate these challenges will likely continue into the third quarter.
So still working through it.
Yeah, it really highlights the complexities, you know? When established businesses upgrade their core tech platforms, it's not always smooth sailing.
Definitely. Okay, let's shift gears to their Jack on Track plan. What are the main goals of this strategy?
Right, Jack on Track. It's built around 3 core objectives, all aimed at driving sustainable long-term growth.
Okay, what's the first one?
First, strengthen their financial position. Basically, generate more cash flow, reduce debt, but still strategically invest in tech and restaurant upgrades.
Okay, shore up the balance sheet. Makes sense. Second,
Optimize the restaurant portfolio. That means closing underperforming locations to get consistent net unit growth and, crucially, improve the profitability of each unit overall. Better unit economics.
right, prove the portfolio for health.
Yeah.
And the third objective.
Finally, they're focused on simplifying the business model and just making their strategy clearer for investors to understand, kind of cleaning up the story.
So it sounds like a move towards a more streamlined, financially sound operation. Let's look at how the Jack in the Box brand itself performed. Same-store sales down 4.4%. What factors contributed to that drop?
Well, that decrease was primarily driven by fewer customer transactions.
Fewer people coming in.
Yeah, and also a less favorable mix of products sold. People may be trading down a bit,
Okay.
although they did see some offset from raising prices.
Price increases helped cushion it somewhat.
A little, yeah. On a positive note, though, their digital sales channels and the rollout of those in-store ordering kiosks are showing strong growth.
So digital and kiosks are bright spots.
Definitely. They said they're actually ahead of their target to reach 20% digital sales.
Okay, good momentum there. And what's happening with the actual number of Jack in the Box restaurants? Any openings or closings?
During the quarter, they opened 5 new restaurants,
Okay.
but they also made the decision to close 12.
Net decline of 7 then for the quarter. What about looking ahead?
Looking ahead to fiscal year 2025, they have plans to open between 35 and 40 new locations.
Okay. Accelerating openings next year.
Seems to be the plan, including their entry into the Chicago market, which is a big move for them.
Right, Chicago's new territory. Now, the profitability at the restaurant level for Jack,
Mm-hmm.
that also declined, you said, to 19.6%.
Yes, down from 23.6% last year.
What squeezed those margins?
It was several things hitting at once. The lower sales volume, obviously that hurts profitability.
Less leverage.
Exactly. Then they also faced ongoing cost pressures from inflation commodities, wages, utilities.
The usual suspects.
Right. Plus increased overall operating expenses. These negatives were partly mitigated by the price increases they took and also some favorable terms they got on beverage supplies.
Okay, so some offsets. Can you break down the costs a bit more, like food and labor?
Sure. Food and packaging costs actually saw a slight decrease overall, mainly because of those beverage agreements and price adjustments.
Oh, okay.
But this was partially offset by a 3.4% increase in the cost of raw materials, actual food inflation.
Got it. What about labor? That's been a big topic everywhere.
Huge impact here. Labor costs rose significantly due to a 10.6% increase in wages.
10% wage inflation. Wow.
Yeah, and they largely pointed the finger at the minimum wage law in California.
Right, that AB 1228 law. Big impact for QSRs there.
Definitely. Lastly, occupancy costs, rent, utilities, and other operating expenses, like higher fees for third-party delivery, also went up and contributed to the margin decline.
Okay, a lot of pressure points there. Now, turning our attention to Del Taco, their system-wide same-store sales were down 3.6%. What's the story there?
Well, it's a pretty similar story to Jack in the Box, actually.
Okay.
The sales decline at Del Taco was mainly due to fewer customer visits, fewer transactions.
Again, traffic down.
Right. And again, partially offset by price increases they put in place.
Any tech progress at Del Taco?
Yep. They've also made progress there. All company-owned Del Taco restaurants now have ordering kiosks.
100% company kiosks. Interesting.
Yeah, and that's contributing to a digital sales mix of over 18% across the entire Del Taco system.
So similar digital penetration to Jack.
Pretty close. They also noted some positive early results from efforts they're making to optimize the Del Taco menu. Simplify it, maybe?
And how did Del Taco's profitability hold up? Or maybe not hold up?
Yeah, it didn't hold up so well. Their restaurant-level margin saw a significant decrease. It fell to 12.8%.
12.8%. Ouch.
Yeah, that's a drop of 4 full percentage points, 400 basis points.
And the drivers are similar. Lower sales, inflation.
Exactly the same pressures we saw at Jack. Lower sales, inflationary pressures on commodities and wages, partially offset by price increases.
Did they get the same beverage deal help?
They did benefit from favorable beverage funding, too, which helped slightly reduce food and packaging costs.
But commodity inflation was higher.
Yes, they faced a higher rate of commodity inflation at Del Taco, 5.7%.
Okay. And labor? California impact again.
Huge impact again. Labor costs at Del Taco increased substantially with an 11.7% rise in wages.
Even higher wage inflation than at Jack.
Slightly higher, yeah. And again, primarily attributed to California's minimum wage, they also saw higher occupancy and other operating costs from utilities and maintenance.
Got it. What about Del Taco's restaurant count?
They opened 6 new locations and closed 4 during the quarter.
Net gain of 2.
Yep, bringing their total to 591 Del Taco restaurants.
Now, this is a really significant development you mentioned earlier. The company is exploring strategic alternatives for Del Taco. What exactly does that mean?
It means they're looking at options for the future of the brand. They announced they're in the preliminary stages of exploring various strategic options,
Including potentially selling it.
That seems to be the main implication. They noted they've already received significant early interest in a potential sale or divestiture.
Already get interest?
That's what they said. However, they were quick to emphasize that no formal marketing process has actually started yet.
Okay, so early days, but exploring a sale is clearly on the table.
It really appears that simplifying their overall business by potentially selling off Del Taco is a serious consideration for them right now.
Interesting. How are the franchisees reacting to all this, especially the Jack on Track plan?
Well, according to the company, the conversations they've had with their franchisees about the plan have been positive and supportive.
Really? Even with store closures potentially coming?
Apparently so. They said there's a shared understanding of the need to focus on these long-term growth initiatives. Franchisees, being long-term business owners themselves, seem to recognize the rationale behind these strategic shifts, at least according to management.
Okay. In this industry, the value proposition is always key. What's Jack in the Box's current thinking on what value means to their customers today? Is it just about price?
They emphasize that their definition of value goes beyond just offering the lowest prices.
Okay, what else then?
They believe it also encompasses the overall guest experience and satisfaction. So quality, speed, friendliness, the whole package.
Yeah.
To that end, they're focusing on their munchie meal offerings, which have always been a value driver for them.
Yeah, those are popular.
Also, their core value menu items, and importantly, introducing those innovative LTOs to provide novelty and excitement, which can also be a form of value.
Bringing people in for something new.
Exactly. They specifically highlighted recent examples like chili crisp flavored curly fries and barbecue chip flavored curly fries. Trying some different things.
Definitely different. Okay, looking ahead now, what are some of the trends they're seeing right now, and what's their outlook for the upcoming third quarter?
They indicated that their performance in the early part of Q3 is tracking pretty much in line with what they saw in Q2.
So similar trends continuing.
Yes, which is consistent with the financial guidance they already issued. They reiterated that the overall industry environment continues to be challenging.
No surprise there.
And they also put a number on the IT issues impact. They estimated that those POS system integration problems are still negatively impacting same-store sales by about 1% to 2%.
1% to 2% drag from IT. Okay.
Yeah. They also pointed out again that their current customer base is more heavily weighted towards those lower-income consumers who are feeling the pressure most.
Understood. What about the store closures they mentioned in the Jack on Track plan?
Yeah.
Any more detail on where or when?
Not a lot of specifics yet. They anticipate closures will occur throughout their system, driven mainly by economic considerations, unit profitability, basically.
Makes sense.
And it will likely affect a fairly broad range of franchisees, not just one or two. They said expect more details in August.
Okay, more to come on that. And new market expansion. Still happening despite the closures.
Yes, they plan to continue expanding into new geographic markets. But there's a shift, a greater emphasis on growth being led by their franchisees now.
More franchise-led development.
Exactly. They expect to see conversions of existing restaurants in Chicago to the Jack brand by the end of this fiscal year.
So Chicago's moving forward.
Yep, along with continued development in other newer markets like Louisville, Salt Lake City, and Florida.
Okay. And any color on how different times of the day are performing? Breakfast, lunch, dinner?
They said they saw some sales pressure across various day parts, particularly during lunch and dinner.
Lunch and dinner hit hardest.
Yeah, but it was relatively consistent overall, not one day part falling off a cliff. They are aiming to build on the success of recent LTOs, like they mentioned some Nashville hot mozzarella sticks and a Red Bull partnership, to drive traffic across all day parts.
Trying to pull levers where they can.
Yeah.
So taking all of this into account, What's the bigger picture here for investors? What are the key takeaways for you?
Well, first, the decline in same-store sales and profit margins really reflects those broader economic pressures impacting the whole restaurant industry right now: inflation, cautious consumers, etc.
It's a tough environment.
It really is. Second, the big investments they're making in tech and digital, that signals a clear long-term strategic focus on trying to enhance competitiveness and customer engagement.
Playing the long game there.
Third, the Jack on Track plan itself clearly indicates that strategic shift towards a more asset-light model and trying to build a stronger financial foundation. Reducing debt is key there.
Simplification and financial health.
Right. Fourth, the potential divestiture of Del Taco, that would be a major simplification of the company's operational focus, letting them concentrate solely on the Jack brand.
A huge potential change.
Absolutely. Fifth, the challenges they've hit with the POS integration, that just underscores how complex upgrading technology can be in established businesses. It's not always plug and play.
Growing pains.
Definitely. And finally, you really can't ignore the substantial impact of California's minimum wage law on labor costs for both brands. That's a critical factor investors will be watching very closely.
Lots for investors to chew on there. All right, now for our This Is Not Financial Advice segment. Based on everything we've discussed, give us an outrageous but plausible trade idea.
Okay, outrageous but plausible trade idea number one, focused on Jack in the Box itself.
Let's hear it.
So, given the clear challenges they're having integrating their new POS system with legacy tech and their stated goal of becoming a digital leader,
Right.
Consider this. Maybe a speculative long position in a small cap tech company that specializes specifically in restaurant POS integration and data migration, one that could smooth out these kinds of transitions.
Ah, potential acquisition target.
Exactly. If these IT issues persist or get worse, Jack might decide it's strategically necessary to just acquire that expertise to speed up their digital transformation and stop the sales bleeding from IT problems.
So the current tech struggles could make a niche integration specialist look very attractive.
Potentially. A well-positioned niche player could become a target. Again, purely speculative, not financial advice.
Got it. Outrageous idea number one. How about one related to Del Taco?
Okay, idea number two, focusing on Del Taco. With the company explicitly stating they're exploring strategic alternatives and reporting significant early interest.
Right, the potential sale.
Consider a speculative long position in, say, a distressed debt fund, or maybe a private equity firm that specializes in acquiring underperforming or non-core restaurant assets.
Okay, why them?
Well, if the divestiture of Del Taco doesn't happen as expected, maybe the price isn't right or the terms are bad.
Like it drags on.
Exactly. Or maybe Jack sells the brand but keeps some of the real estate or underperforming locations initially. These kinds of specialized funds might see an opportunity to swoop in and acquire individual struggling Del Taco locations, or maybe small packages of them at a deep discount, as Jack pivots focus entirely to its core brand.
So betting on a messy or incomplete divestiture, creating opportunities for distressed asset buyers.
Precisely. A bit of a complex scenario, but plausible if the main sale doesn't go smoothly. And again, definitely not financial advice.
Understood. Two very interesting and definitely outrageous but plausible ideas there.
Always fun to speculate.
Fascinating deep dive into Jack in the Box's latest earnings call. It's really clear they're navigating a complex environment, juggling inflation, consumer pressure, and undertaking some significant strategic initiatives like Jack on Track and the Del Taco review.
Yeah, a lot moving parts.
Key areas for you, the listener, to watch will definitely be their progress in that digital transformation, especially ironing out those IT kinks.
And the execution of the Jack on Track plan, particularly store closures and debt reduction.
And of course, any developments regarding the future of the Del Taco brand. That's a big one.
Huge.
Remember, this discussion is for informational purposes only. It should absolutely not be considered investment advice. Always conduct your own thorough research before making any financial decisions.